I'm Dan Ridsdale and welcome to Edison TV. Today I'm joined by James Haslam, CFO of ELMO Software. ELMO Software are an Australian listed business capitalised at around about 320 million Australian dollars, and they provide a wide range of HR payroll services to small and medium-sized businesses through a SaaS-based business model. James, many thanks for joining me today.
Thanks, Dan.
Could you just start by giving us an overview of the business?
Sure. So ELMO Software is, as you just said, a leading provider of software as a service, HR, payroll, and expense management solutions. We run the business through two segments. So we run our mid-market segment, which is ELMO, and a small business segment, Breathe. So these two segments serve the two different distinct markets. Mid-market typically employ customers with employees between 50 and 2,000, and small business with employees under 50. The main difference between those two segments are the complexity. The mid-market customers tend to be more complex needs. Small business a much more simple solution.
Great, thanks. And you've recently reported your first half results. Could you talk us through the key highlights there in terms of your key KPIs for the business?
Yeah, so there's three key themes that have come through these results. So first, we saw the return of high organic growth to the business. So we delivered annual recurring revenue growth annualised for a period of 35%, closing at $98 million, so tantalising close to the $100 million mark, this is Australian dollars. Secondly, we're seeing operational efficiencies come through the business. So we're driving more cost efficiency through, and that's largely a function of our revenue growth or ARR growth accelerating faster than our rate of cost investment. And thirdly, we're seeing those operational efficiencies translate into cash flow as well. So our operating cash burn has reduced by 36% over the period, from 2.8 million a month to 1.8 million per month. And as we've laid out that pathway to cash flow break even. So those are the three key themes. And we've seen a lot of improvement in operational metrics or unit economics through the period as well, particularly reducing churn. We've improving net dollar retention, so now at 103% over 100% mark, which is showing how existing customers are being cross-sold to, and plus some broad improvements in the LTV to CAC ratio as well across both segments. So we're seeing that just under 8 times on a mid-market and 10 times in small business. So really shows how the market has returned, how we're seeing customers, new customers coming on board, and existing customers procuring again and driving these high growth rates, and also the benefits, these unit economics.
Great. And you talk about the improving metrics, and you reported 35% organic growth for the period. We've seen a lot of businesses where some have had a bit of a windfall and some are still going strong. Can you talk about the sustainability of that growth?
Yeah, certainly, and we really expect to continue these high growth rates going through the next few years. We've got the markets we currently operate in. We're seeing a lot of traction in those markets to sustain these current rates. But important to note, there's two segments that we've got that aren't contributing in any significant way, and these are going to actually really help drive the future growth rate. So when we talk about the sustainability. So if we just talk about the markets we operate in, so we operate in the Australia, New Zealand and UK markets. In the Australia market, primarily it's what we call the mid-market ELMO solution. And in the UK, we've got the Web Expenses Acquired Entity, so a single point solution, and the Breathe small business solution. Those are what are contributing to the results today. What we're seeing going forward is those platforms expect to continue to grow like they have been. But also, in the mid-market, we've launched ELMO into the UK. So the mid-market solution now coming into the UK, and it's starting to feature in sales via that web expensive channel. So that's been branded as the ELMO UK. And then on the small business is bringing the Breathe solution into the Australian market. So that also has happened in the last 12 months, and that's going through ramp up in marketing and brand awareness, etc. So those two pockets haven't even got going yet. So we expect those to really fire, particularly through FY23 and 24, and they'll be helping sustain those high growth rates as well as the remainder of the organic business.
No, very, very interesting. I mean, you talked about your growth strategy there, but just diving that into in a little bit more depth. Can you talk about your different vectors for growth and how those build up over time?
So we look at the two segments again. So the mid market, and we look at the small business separately. So when we look at mid market, I can break it down into two distinct buckets. New business, so these are new customers that come in online, and then existing business as well. So this is the existing customer base, the cross sell to existing customers. Both are heavily important as we land and expand. It's the land and expand strategy, as we call it. So winning new customers, as it sounds. We see new customers coming on board, typically taking 3 modules in their first license. And then with our existing customer base, the growth there, which is about 35% of our incremental ARR, is being driven from the upsell of additional modules. So that's a key part of that strategy, is winning new customers, building up the customer pool, and then increasing the penetration of our existing customers with more modules. And you've seen that mid-market penetration rate increase from an average of 2.3 modules out of 18 to 2.6 just in a 6-month period, and we expect that to be sustained going forwards. Small business, similar. So the small business solution Breathe was acquired as a effectively single module, and we've actually deployed additional modules to that since the acquisition. So in the UK market, we've added learning, we've added the rostering tool as well, and so those have been cross-sold now to existing customers. In the Australian market, we also have Payroll, and that is something that will come down into the UK market as well, and that's going through those sort of final stages of readiness to be able to launch it in the pipeline. And so those additional modules will allow that enablement of that existing customer pool to increase in that small business channel as well. And I've touched on when you said the other vectors are the mid-market UK and the small business in Australia, so those will be key pockets of growth as well.
Perfect. So just looking at the business's outlook for the medium term. So you've talked about the 35% or strong growth rates being sustainable. Can you talk about the operational leverage within the business and what that should mean for, I guess, profits and ultimately cash generation?
Yeah, certainly. So if I go back a few years, when we're laying out the plan for the business and how we're going to scale up and what we saw at scale and different iterations and what that meant for leverage. So certainly getting to the $100 million ARR mark is that our modelling was showing that we expect to be driving increased leverage. We'll be sustaining a higher growth rate and cost growth to be more muted, largely because we built out a lot of the infrastructure for a much larger business. So we have the infrastructure in place today to handle larger business still tomorrow. So I expect that to be coming through at a faster rate as we go. Particular areas of leverage are the G&A, which you would have seen, or general administration costs, which you would have seen come through down to like 25% or so now of revenue, and I expect that to come down further, and that was over 50% if you go back about 3 or 4 years. So expect more leverage to come through there because we've got the operating footprint in Australia, we have the operating footprint in the UK, even for the mid-market we have that web expenses footprint, and a small business as well. We've done the investment to build out the infrastructure in the Australian market. So we've built all this infrastructure out. R&D is another. We've invested significantly in R&D over the last few years, and I expect that's going to be, you're going to start seeing that leverage come through. It's got a large pool of engineers, and I expect that to be leveraged harder, and that rate of R&D as a percentage of revenue to be coming down.
Great. And then finally, I mean, you've made acquisitions over the course of the last few years, and that's been central to your strategy, really. Can you talk about what we should expect in the future and what kind of assets you might be looking for in terms of your future acquisitions?
Certainly, M&A is a core part of our DNA as well. I mean, our focus is always on organic growth, but we see M&A as a real enabler for some acceleration, but also for market entry as well. So if we looked at the 2 last acquisitions and what they brought, I mean, they brought the geographic expansion into the UK market, and they also brought the segment expansion into the small business market with the Breathe acquisition. So what we see with M&A is that is a great way to enter a new market. So when we've done our work in the past analysing new markets, you could go the land and expand and just build an office and a sales team and start selling, but you won't have any brand equity. Or you can de-risk that by buying an asset that already has a good operating footprint. Web Expense is a great example, had 1,000 plus customers, and you've got your sales infrastructure, your office footprint, and your management team, and being able to then leverage that by bringing in your product in, so bringing the ELMO mid-market product in to be able to begin that cross-sell work. So that's something certainly we see as a good route to market entry. And Breathe on the other side was a segmental play that allowed us to sort of expand into that small business area under 50 customers, which have different needs and also different technology requirements, less complexity. We couldn't service that before because we had too much complexity in the mid-market to be able to move down, but Breathe enables that, to be able to capture those customers in the Australian market. So M&A certainly enables a quicker entry into the markets. If I'm looking more prospectively, where does M&A take us in the future? It could take us wider in terms of that module count, deeper in terms of what we already do, but also into those new geographies as well that we're sort of looking at now as with a line of sight as to where to next after the UK and further penetration in Australia.
Perfect. Look forward to seeing what happens next. James, many thanks for joining us today.
Great. Thank you very much, Dan.